So disposal or liquidation of a partnership interest. This is where, so before with the distribution, my ownership in the partnership didn't change, right? I was a third partner at the beginning. I got $40,000 out. I'm still a third partner. That doesn't change, that distribution doesn't change my ownership. In both liquidations and disposals, your ownership does change in some way. Either you are completely selling the partnership or one of the other partners is buying you out. So, a liquidation occurs when a partner's entire interest is redeemed by the partnership. So this is where the partnership buys you out, okay? I think I said when another partner buys you out, but this is when the partnership buys you out. Most of the rules concerning non-liquidating distributions also apply to liquidating distributions. So this is again why you need to know what the basis is. Distribution in money, of money in excess of basis causes a capital gain. If property is received, no gain is recognized, but the basis of the property is adjusted. So just like we had that adjustment earlier. One difference is that a loss can be recognized on a liquidating distribution. You're getting out of the partnership. You're leaving your investment, right? So just like with stocks, if you have that as an investment, if the price goes down and you sell it, you don't own the stock anymore, but you could recognize a gain on that loss. Same sort of concept. So now you can recognize a gain even if you don't have basis in it. Loss occurs when the amounts received in liquidation are less than the partner's outside basis. Loss can only be recognized after the final payment is received from the partnership and when only money, receivables, or inventory are distributed. So not when property is distributed. So example, Cassandra, $20,000 basis in her partnership. She received a liquidating distribution from the partnership. She received $12,000 and equipment with a basis to the partnership of $6,000. She's got no gain or loss on the liquidating distribution because $12,000, her basis was $20,000, she's getting $12,000, and $6,000, she's getting $18,000. The equipment is going to have a basis to her of $8,000. Where does that $8,000 come from? But that is the original basis of $6,000 plus her loss. So she's not going to recognize the loss at that time. So just like before, they're not going to recognize the gain on that furniture at that point. They'll recognize it when they sell it. In this case, she's going to recognize the loss when she actually sells the equipment. So that loss attaches to the equipment in the form of an increase in basis. I know that's kind of weird, a loss and an increase. But like the original loss, or the original basis was, what, 6,000? What's the basis in
20,000.
Oh, 6,000 for the, that's useless. So this is the basis in the equipment. So her basis, so she's getting 6,000 in cash. Her basis in the partnership is 20,000. So what she's receiving is $18,000. So normally the basis that she would carry over is $6,000. Because that basis carries over. The partner is stepping into the shoes of the partnership. Okay? But she has a loss of $2,000. So what she's going to do is attach that loss to the basis of the equipment. So the new basis in the equipment, sorry, now that's squeaky, is $8,000. That means, think about this. If she sells that equipment for $10,000 and she doesn't get to attach that partnership loss, she's gonna have a $4,000 gain, right? If she sells it for $10,000, $6,000 basis, she's gonna have a $4,000 gain. But by attaching that $2,000 to the equipment, if she sells it for $10,000, now she's just gonna have a $2,000 gain. So that's where her tax savings are gonna come in. That's where her loss is going to benefit her. Because she has the equipment, she's got to attach it. She's got to attach that loss to the equipment. Because remember, it says up here, loss can only be recognized. So this is a case where she can't recognize the loss currently. Even though she had a $2,000 loss, because she received equipment, yes?
So I'm just trying to follow this because it says, because I'm reading the example in it, and that $2,000 is coming from the partnership minus the cash received, and you're saying it's from the total of the cash and the equipment together, which like it still comes out to the same thing.
The $2,000 is coming from the, so first what you would want to do is, okay, so add the cash and the equipment together.
But that's not what it's saying. It says the loss can only be recognized after the final payment is received and when only money, receivables, and or inventory are distributed.
This example is not that. Because in this case, equipment was received.
Right. But it says it.
One caveat, the loss can be recognized. Okay, so they should say the loss can currently be recognized.
Right, but it says liquidating distribution, so you wouldn't even include the equipment. You would just take her basis minus the cash that she received, right? Because that's what that example is telling you. Or that's what it's telling me, is that you ignore the equipment because it's technically not.
No, you don't ignore the equipment.
Well, you add but that's where you get the 2,000 is from the basis minus the cash. Instead of, I mean, it works both ways in this problem, but I want to make sure that like if I have another problem that comes up like that,
yeah,
that it's the cash or it's her basis minus the cash, not the cash plus equipment or whatever it is minus the basis.
Here's what we can do. Let's take.
Does that make sense?
No, but that's, I mean, I'm not right now, I should say.
Okay.
Not at this second. Let's do it this way. All right, so her basis in the partnership is $20,000.
Mm-hmm.
Let's take out the cash. Okay. So her adjusted basis now is $8,000. She receives $6,000, another distribution, the property, of $6,000, right? So now there's $2,000 left, which if she was still in the partnership, she would still have a $2,000 basis, right?
In the partnership?
If she still owned she's getting out of the partnership. She's no longer gonna be in the partnership, she's getting out of it. So if she were not getting out of the partnership, her basis in the partnership would now be $2,000. Right? So essentially what they're doing is attaching that remaining partnership basis to the property.
So will it always be added to the property if there's a remaining basis that they would have in the partnership, but they're getting out of it?
If they got property.
But only if it's property?
Only if they got property. Because here's the thing, if she didn't get property, if she got, instead of this, she got $18,000 in cash, she would have a loss of $2,000. I'm kind of doing this backwards. I should say the cash first, and then it would be a negative number here. She would have a loss of $2,000. She gets to claim that loss on her taxes.
Because the cash she received didn't equal her basis?
Yes. But because she's receiving property, she now has to attach that loss to the property. So she doesn't get it currently. She'll get it when she sells the property in the form of an increase in basis. So which will reduce any gain that she has or increase any loss that she has on that property.
So like if she sells it for less than her basis, then she would have
A loss.
gain or a loss.
A loss. If she sells it for less than her basis,
But if she sells it for more,
then she would have a gain.
and you go off of the like new basis with the added 2,000.
Yes. What are you laughing at, Andy?
No, because it's so easy to understand. It's so very easy to understand because here it's loss probably.
Mhm.
Because if you see it's 12 plus 6 is 18
Mhm.
and 20, so you have a 2,000 loss. But she don't get it right now because
Right, because she had property.
yeah, she have property. So
Right.
you're supposed to understand. But for me, it's so easy to. Yeah.
I don't think it's easy for me. I think it's, I mean, you have to kind of think through it. And I think the way that the book is presenting it makes it harder to understand. I think that if you just take the cash out, if she gets property, if she doesn't get property, she gets the loss, right? If she gets property, then we're gonna take the cash out, that loss, we're gonna add it to the basis of the property.
So it's not a loss.
So she doesn't get this currently, no, but she will get a tax benefit from it at the point that she sells the property. So let's say, let's use some different numbers here. So let's say that we had a partnership basis of, really don't like this pen. Let me see if the one up here works any better. Okay, so let's use some different numbers. So we've gone through, we had a beginning basis, we've owned this partnership for a few years, we had income, we had some distributions, we had, we've adjusted our basis, and right now, our basis is sitting at 25,722, beginning this year, okay? We're gonna get out of this partnership. We're gonna liquidate, the partnership is gonna redeem our share, get us out. But what they're doing is they're gonna pay us cash of 15,000, and we're gonna get, let's say we get a truck that has a basis of 6,000. So altogether, we're getting $21,000 for the stuff, but our basis is 25,722. That means we paid tax on this money already. This is what's sitting in our bank account, but the bank's only gonna give us $21,000. That makes sense? So, all right, so where do we get our benefit here? Well, because we're getting a truck, what we're gonna do is we're gonna adjust first 25,722 minus the cash that we got of 15,000. So $10,720. If this were all in cash, well, sorry, if we only got 15,000, we'd have a loss of 10,720. This part here is gonna attach to the $6,000 of truck. So now our truck basis is 6,000 plus 10,720, so 16,720. If we sell this truck, say we keep it for a year or so, we end up selling it for, I don't know, for $8,000. Our basis is 16,720. At this time, we're gonna have a loss then of 87.20. that we can then take. Okay, we can't take it at the time, we can't take this basis, maybe I should have said we sold it for 6,000. Let's say we sell it for 6,000, sell it for, because that's the value there, let's sell it for 6,000. Basis 16,720, and we have a loss of 10,720. At that point, we can take that loss, but not at this point. So part of that loss is this. Did I get that right? 5.
Sir, excuse me. For me, here, the 10,720 is include 6,000 inside. Here, because you take out 25,000 minus 15, you get 10,000. 10,720 is the 6,000 for the dock include.
This is our basis. Yes, it includes.
Yeah, so if it includes, you can get 16.
It include, well, you have your original basis of 6,000.
Yeah.
And then the loss that you didn't get to take. Oh, because it's six, I probably did
Yeah.
my numbers are off. You're right, because the 6,000.
Yeah. Including the
It's too much,
10,000.
yeah. So,
Maybe 3,000 or 4,000 loss.
anyway, what you wanna do is, so the loss that you didn't get to take, you attach that to the basis of the property that you received. So that when you sell it, then you get to take the loss. Alright, we've kind of beaten that one to death. Question? I drove Kelsey off. Alright. So that's a liquidating distribution. So if several assets are distributed in liquidation, the partner does not have outside basis to cover the basis in the partnership assets distributed. The outside basis is allocated among the distributed assets as follows. First, the partnership basis is reduced by any cash. Next, any remaining basis would cover the basis in receivables or inventory. Any remaining basis is allocated to other assets distributed in proportion to each asset's basis. So this is if you've got multiple types of assets that were distributed. So here's an example. Kelsey has a basis in her partnership interest of, she left before we could get to her example. Partnership interest of $10,000. She receives the following assets in complete liquidation of the partnership interest. So $13,000. Her basis in the partnership is $10,000. So she's getting more than what she actually put in. No, I'm sorry, $11,000. I did my math wrong. 8, yeah. So she has no recognized gain or loss. Her $10,000 outside basis is allocated as follows. So again, she's not going to recognize any gain here. What she's going to do is then reduce the basis of these items. So just like we increase the basis here, now we're reducing the basis here by the amount of the loss. So the cash is what the cash is. The inventory is what the inventory is. The equipment, however, that $6,000 has to be allocated, and this is the basis, the ending basis. So $5,000 of her basis is remaining, because she had $10,000, $5,000 was taken up with cash and inventory, so $5,000 is left. So we've got to reduce the basis of these items proportionally. So we'll take the 5,000 times 2,000 divided by the total 6,000 that she had. So this 2,000 divided by 6,000, 4,000 divided by 6,000, that's the allocated percentage of those items from up here, right? So 1/3 and 2/3. And then we're gonna multiply that by the 5,000. That's the basis that's gonna carry over. She's not gonna recognize a gain because she received property. If she didn't receive property, she would recognize a gain then, just like any other asset. So if they paid her, it's worth $10,000, they wrote her a check for $11,000 instead of all this other stuff, she'd have a gain of $1,000, just like any other asset. But because she received property, that gain gets to be attached to the assets, okay? Now, that's a liquidation. What if we sell our partnership interest? So, it's just like any other type of asset. Again, liquidation is when the partnership purchases it from you, buys you out. They're tired of you, they don't want you there, we're gonna buy you out. Which, by the way, breaking up partnerships is worse than divorce. Especially when friends have gone into partnership together, and oftentimes that's what happens is partnerships have probably destroyed more friendships than marriages have. So sale of partnership interest, similar to the sale of any capital asset. Partner determines the amount realized from the sale and subtracts the basis of the partnership interest at the date of the sale. So the gain or loss is a capital item, assuming that the partner is an individual and they report it on Schedule D. So again, we have to determine what our basis is. So in this case, we've got, this is very simple. So 30% partnership interest, she bought it for $23,000. Her share of income, so her beginning base is 23, and then she had income in 2020, 2021, 2022. So total basis of 58,000. She got 74,000 for it. So her gain is $16,000. So just like any other asset. Let's see. The partner may be subject, no, so this is capital gain. The partner, though, could be subject to ordinary gain if the partnership has substantially appreciated inventory or accounts receivable. Think about this for a second, because if you were to sell that inventory or sell the accounts receivable, it would be taxed as ordinary income, right? So just because you're selling your partnership interest, and if you are you're not going to avoid the tax on that. So if the partnership sold or collected these items, ordinary income would result. Partner would share in that ordinary income. Partner who is allowed capital gain treatment on the sale of partnership interest would effectively convert ordinary income to capital gain income and benefit from the preferential gain rate. So to try and avoid individuals gaming the system there. So same facts, however, the partnership has uncollected accounts receivable with a fair market value of $20,000 and a basis of 0. So if the partner was still in business, that partnership would have ordinary income of $20,000 at some point, right? So Jana's shares of the receivables is $6,000. So $6,000 of that $16,000 gain would be ordinary, $10,000 would be capital. Okay, so her portion, ownership portion of the appreciated receivables or accounts receivable. Yeah. All right. So let's take a look at this and see if we can work our way through it. Shelley has a basis in her partnership interest of $30,000. She receives the following assets in complete liquidation of the partnership interest. So she got cash of $9,000, inventory of $6,000, equipment and land. So what is that? 20 plus 15, so $35,000. Her basis is 30. So cash and inventory are going to be distributed, you know, at what they're worth. So we're left with $15,000, right? What we have remaining is 8,000 and 12,000. So we've got to figure out the proportion of each of these and then multiply it by the remaining basis. So the remaining basis is 15,000. So for the equipment, 15,000 times 8,000 over 20, 8 over 20. I realize I could reduce that further. And then for the land, 15,000 times 12 over 20, or 6 over 10, or 3, and my calculator's back there. So, what is her recognized gain? Her recognized gain is 0. She's not gonna recognize a gain. Even though she had one, she got $35,000 worth of property. Her basis was $30,000. If she got it all in cash, she'd have a $5,000 gain. But because she got equipment and land, we can attach that gain to these assets. Okay? What is her basis in each of the assets distributed? Oh, what is this? 10, 4. So this is 1/5. And this is 4/5. Do I have that right? So 15,000. I don't know what the math is.
The first one's 6,000.
Okay, so this one must be 9,000.
Yeah.
So that's the basis in those assets. So when she goes to sell those assets, now instead of having this as a basis, say she sold this equipment for $10,000, instead of having a $2,000 gain, now she's gonna have a $4,000 gain. So that gain is gonna be attached, or that basis is attached to that asset, or that gain is attached to that asset in the form of a reduced basis. Make sense? Sorta? Kinda? It all has to do with whether that income has been, or whether it's already been taxed or not. Because they want to make sure they capture it. Can you imagine trying to come up with these rules? Trying to think of every single scenario? Yeah. All right, the rest of this is an example, which I'm not going to go through. But here's if you wanted to look through it. So we would start with the income. So these partnerships would have an income statement and balance sheet. You'd get that information from the income statement and the balance sheet. Although you may have to adjust certain things between accrual accounting and cash accounting. So for example, let's see if there's anything here. Oh, well, luckily they've done all of this in tax basis, but if and we'll get into this a little bit more when we look in chapter 15, when we talk about book tax differences, because like our depreciation for book purposes is gonna be different than our depreciation for tax purposes. So an adjustment would have to be made, and you'll see when we get to chapter 15, there's a spot on the tax form for making those adjustments. And that's, little heads up, that's the part that most students kind of struggle with in that chapter. And it's conceptually, it's hard. You really kind of have to think through it. Let's see, meals isn't such a problem nowadays because it's 100%. When it's 50% though, you've got to make an adjustment for that too, because it'd be 100% on the financial statements, but 50% on the tax return. Charitable contributions as well, maybe limited on the tax return, but you get to take them 100% for on the financial statements. Well, you get to take them. You don't want expenses on the financial statements, but you do want expenses on the tax return, right? So there's this kind of push-pull between those two. Anyway, so this example gives you all the information and shows you where it would all go on the 1065. And then here's the balance sheet. So there is always like a balance sheet, and it's the book balance, the balance sheet per books is listed here. So you'll see, I think they've got an M1 here. Yeah, M1. Okay, so this is the form that I was talking about where you have a reconciliation per books with the return, you're comparing it. So you always start with your net income per book, so on your income statement, whatever that bottom line number is, and then you may have to add or subtract certain items because they either are showing up here, but they're not on the books, or they're on the books, but they're not showing up on the tax return. So that's what the M1 is for. Excuse me. So, entertainment. If you say you had a country club membership, your business has a country club membership, well, that's not deductible for tax purposes, but it's an expense on your financial statements, right? So, like, maybe that's what this is, the 6173. So now they have to, they've got to add that back to the income. So on the left side, we have items that are added back, and then on the right side, we have items that are subtracted to get it split. But your beginning number is always your net income per books. Your ending number is always your net income per tax return. And then everything in between gets you from point A to point B. Point A to point Z. And then here's what the K1 would look like for, I don't know if it's just one of the partners. No, it's all of the partners. Okay. Questions? I thought I'd have more time to look at the homework problems. But does anybody have a homework problem they